Hey, what's up everyone? It's Griffin here, and as always, hope you're having a great day. So I speak pretty often on my socials, specifically my YouTube channel, about real estate investing and how over the past couple of years that I've been doing this, real estate investing has absolutely become something that I've grown to love, mostly because it's just so tangible and there's multiple different ways that you can actually create a return on your investment. That's something that I really like, being able to play with my investment to my advantage in order to create a more tangible return for me. Now, this is something that has also created quite a bit of equity for me over the past couple of years doing this, after now buying and selling over at least 10 properties, some of which I still hold, most of which I've added value to, and then sold for a profit in order to reinvest that profit back into the growth of the portfolio and my net worth over time. So that's something I want to speak about today, and really just why I view real estate investing as such a powerful asset to help strive towards financial independence and passive income over time. And truly, after being a real estate investor now for a couple of years, I see property kind of as an asset class in really its own class, I guess we could say, because when you buy and hold real estate longer term, you truly get to take advantage of all of the different wealth building principles that real estate has to offer, and that is difficult to replicate in other asset classes, right, without monumental amounts of money. So when you're buying and holding residential real estate, for example, you're able to take advantage of leverage, you're able to take advantage of debt pay down, hopefully cash flow, which we're going to be speaking about in today's video, how to analyze a property and what I look for. But yeah, real estate alone is just a great asset class to include into your overall investment portfolio to take advantage of long-term growth through the different principles that we're going to be speaking about today. And by the way, here are a couple of the different properties that I have purchased over the past couple of years. They're basically all small multifamily residential properties. So from a duplex up to a 4 or 5-plex, some of which now we're adding units in order to get up to 6-plex and stuff, but that's regardless of the point. This has allowed me, though, over the past couple of years to analyze hundreds of deals on the MLS. Basically, it's part of my morning routine. I take a look at the market, run numbers on properties that are of interest to me, because at the end of the day, that's where it starts. It starts at my computer. As much as real estate investing is very tangible, boots on the ground, and physical, well, it pretty much usually, at least in my experience, 90% of the time, it'll start at my computer, running the numbers to see if it's even something of interest to me before taking the next step and viewing the property in person. So I've received so many questions over the past couple of years about how I analyze properties, what I look for, how I run the numbers. So that's what we're going to be covering in today's video. It's a really comprehensive video. So if you enjoy the video at any point in time, make sure to drop a like. It really helps the channel grow and reach a wider audience. Also, some of the resources we're going to be looking at in today's video, you can find down below for free in the description, spreadsheets that I've made, and yeah, you can get free access to them. So let's get into a property right off the MLS that we're going to be analyzing. They're just a random one, and then we're going to be analyzing one of my deals that I've done over the past 2 years. All right, so like I said, we're going to pull up a random property that I can just find on the MLS here, and we're going to run the numbers the way that I am typically going to run the numbers at the beginning, to just even assess whether or not this is a property that makes sense from the get-go, right? Because regardless of whether or not I like to add value to the units, or whether or not I want to add units to the property, I should say, it all starts with whether or not the property is going to, at the very least, break even at the beginning. That's usually how I approach a property, because I don't want to be, in the hole hundreds of dollars every single month, especially if I'm not able to make the strategic renovations right at the beginning when I get the property, right? So we're going to go here and search Ottawa, Ontario, and just do a very broad search to begin with. Actually, though, we're going to need to filter this down to say multifamily, right? Multifamilies are going to be those duplexes, triplex, fourplex, etc. All right, so we're going to do multifamily, and the amount, max price, none of that really matters. So we'll just search right there. All right, so here we can see that's definitely narrowed it down quite a bit. Around 54 in the Centertown area, and then a couple over in the Gatineau area. So again, let's just pull up a random property. I've not vetted any of these beforehand, and that way it'll just be more organic. So what does this look like? Those are huge properties, so obviously that's not going to work, especially if it's one of your first properties. 1.5 million, that's also quite a bit. Holy cow, these are expensive. Let's pull up this one, right? $795,000 in Hull. So we'll pull this up and we can see one of the first things I always obviously look at are the photos. So just taking a look at the photos here, we can see, all right, it's definitely an older property in an older neighborhood. The units look decent though. That's fine. Next thing we're going to look at, so this is a 6 unit, 2 times 2 bedroom and 2 times 1 bedroom, as well as 2 times, what is that? Garçonnière in English is a bachelor, right? So it's a 6 unit property here, and we get some basic information about the property. It was built in 1910. That's not necessarily something that bothers me because I'm going to be conducting a inspection on the property in the first place, and that's going to really give me more information about whether or not there's larger issues at hand that need addressing. So the next thing I'll do is get more information. So typically on any one of these MLS websites, you can go to a section where you can click more information, and that's where we're going to get information about the financials, taxes that need to be paid, current income, things of that nature. So coming here, we can see more information, and yeah, like I said, going down, we have, where is it now? More information about, right here, more detail. All right, so potential gross revenue. It's important to understand that the revenues that are listed on a listing are going to be potential revenues. That doesn't necessarily mean that the property is generating that right now. So that's why I always recommend working with a real estate agent so that you can, as soon as you see a property that's of interest to you, message the realtor, and they're going to be able to communicate with the realtor of the seller to get all of the information like the leases that are currently in place and other information, so you can see if whether or not the property is actually generating that amount of income. So in this case, we have $48,000, and then there's a tax section, property assessment. That doesn't really matter as much. Really what we're interested in here is the residential as well as the taxes. So this is now where we're going to go into the spreadsheet that I use in order to calculate some of the preliminary returns to see whether or not I'm even interested in going to see the property in person. All right, so let's look right here. So this is divided up into 3 main sections. Section number 1, we have property values. Section 2, financials. And then section 3 are returns. So we have cash on cash return that we'll be speaking about a bit more in detail, equity returns, and then the total return. So the reason why I divide this up though into cash on cash return and equity returns to begin with is because these are what I like to consider sort of the guaranteed returns of real estate, I guess we could say, because although it's never certain that someone's going to continue paying rent, typically speaking, that is something that they're going to, like, I've only experienced this 1 or 2 times where someone has not paid rent, and you can pretty much bring them to court, and that is something that they owe you. Like, it's a legally binding contract being in a lease with someone. So all that to say, both of these returns are more like what I like to call guaranteed returns, and then any type of appreciation and any type of value add that you're bringing to the property is more like the cherry on top, where it's more of an active return. If you're looking to renovate the properties, raise rents over time, these are more active things that you can do versus these are more of the passive returns that you have. All right, so we're gonna go on to this property, and right now we're just looking as is, not like, negotiating or anything. We're just gonna put the price $795,000 on this property is how much it is being sold for. Now the down payment is, in this case, I put 10%. 10% would only be if you're looking to live in the property and if it was a triplex or less, right? In this case, on a 6-unit, depending on whether or not you're able to speak with a mortgage broker who can get you some more personalized information about this, typically on a 6-plex, you would have to put 20% down minimum. All right, so in this case, I'll just put 20%. And so I will change the formula here. 20% down, we're looking at $160,000. Obviously, that is a lot, especially for most first-time property investors and most first-time buyers that would be watching this video in the first place. So that's why I usually always recommend actually starting with either a duplex or a triplex, because this way you can get an owner-occupant loan and put only 5 or 10% down. That makes a massive difference in the time that it'll take to save and invest towards that first down payment. In this particular case, the same principles apply. It's just I took a random property off the MLS, one of the first ones that appeared. So in this case, though, it would be $160,000. Again, everything would be the same, though. If it was like a duplex and you were putting 5% down or 10% down, you would just change this one down payment. So this leaves us with a sub-mortgage of $636,000 because, well, purchase price minus the down payment. In this case, I also put some sections for renovation loans. So if you're going to request a renovation loan from your lender, this is an amount that you can get, and you'll be paying the same amount of interest on because it's just tacked onto your total mortgage. Just for the sake of simplicity for this example, we're going to put 0, and mortgage insurance also 0, because this would only apply if you're getting a mortgage that is less than 20% down. Okay, I'm going to link another video probably right here going over some of the concrete steps to take towards purchasing your first rental property, and we go into mortgage insurance. But when you're putting 20% down or more, there's no mortgage insurance. So in this case, we're going to put 0 once again. All right, so our total mortgage would be $636,000. All right. Next section is closing costs. All right, so in anytime you purchase a property, there's going to be quite a few closing costs that are tacked on at the beginning, and this is something that I always account for when I'm calculating my total return. So in this case, the down payment's $160,000, just under, and you're going to have to go through, for example, an inspection, notary fees, land transfer tax, mortgage insurance tax, potentially if you're getting mortgage insurance, and other things of that nature. Now, an inspection usually is going to run around $500, might be up to $1,000 depending on the size of the building. We'll just keep it at $500 in this case. Notary fees, so when you're purchasing a property, you need to go to a notary. Down in the US, it's typically just lawyers. Here in Canada, we use notaries in order to, well, notarize the sale of the asset and change the title that is on the house in question, the asset. Usually that's going to run you around $1,500. Now they're kind of going up a bit in price, so let's just put $2,000 to call it even. In the land transfer tax, when you purchase a property, you need to pay a tax to the municipality for having purchased that property. On a property of $800,000, it would probably be quite a bit more than that. So that's something that you can determine when you're closing on the property. You'll get that information. In this case, we'll put like, say, $5,000 because that's probably more, maybe even a bit more. That would be a rough estimate of how much it would be on a property of this value. Mortgage insurance tax, there's none, and then other in this case, we'll just leave it at 0 as well. So for an initial total out of pocket of $167,597. Now again, this looks like a lot and it seems like a lot. Keep in mind, when I purchased my first rental property and I put 5% down on a duplex, my total closing costs were under $20,000 when everything was said and done. So don't just look at this and be discouraged. You can find a property where those values are going to be quite a bit less. So when it really comes down to it, that's the start of where you're going to start inputting values in order to calculate potential returns. And now we can move on to section number 2, where we have the financials. So we have the property income as well as the property expenses. On any rental property, I like to view this as a separate mini business, right? Every rental property is a separate mini business that has its own set of challenges, that has its own income, its own expenses, and challenges that you're able to optimize over time and mold the investment to your liking to hopefully create more equity for you over time as you're holding it. So property income, like I said, you're going to have your initial income that you can get from the product listing. In this case, the initial income is $48,480 is what they're claiming. Again, I would actually go and ask my realtor to get that information so that it's a bit more concrete. In this case, though, if it's $48,480, just for the sake of this example, we'll separate it all equally like this, divided by 4. So this is monthly cash flow. Actually, that's yearly. So I'm going to have to do this as well, divided by 12. All right, so it would be around just over $1,000 per unit on average per month for $4,040 per month in total brute rents. Now we have the property expenses though, right? And of course you're going to change these values also. We have the mortgage, taxes, insurance, maintenance, management, vacancy, and then random, right? All of these are things you need to take into account on your preliminary assessment of the property. And typically I also like to buffer up these values quite a bit so that if some of them end up not actually materializing in the month, you're just looking at extra gravy on top. All right, so the mortgage is really simple to usually calculate. This is actually though where it's important to have a mortgage broker also on hand so that you're first of all pre-approved for a mortgage instead of just looking at properties that you wouldn't even be able to apply to, but also you're going to be able to get the latest rate for your personal situation, right? And by rate, I mean mortgage rate. So in this case, usually I get the exact value for how much it would be per month from mortgagecalculator.org. So I added a link right here for easy access. And this is a site where you can input how much was the total value. It was 795,000. So you can put that in here. The down payment percentage, we'll put 20%. And the interest rate at 3.8, that's pretty high right now. If you're in Canada and you're getting a residential rate, it could probably be around 2.5%. But again, make sure to get the up-to-date value from a mortgage broker. In this case, we'll put a 25-year term. We'll start it in January just for the sake of this example. All of these we can put 0. And then I like to look at the amortization tables on an annual as well as a monthly basis. We can click calculate, and you'll see that the monthly payment for this would be $2,853.20. So we can input that right there. Perfect. And then the taxes is also something that we can find straight on the listing. Municipal tax, total tax amount is $6,424. So I'm just going to copy that. We can put it right in here and divide that by 12 because we're looking at a monthly value right here. Put that in line. All right. Insurance. Also, you need to have a mortgage insurance, a mortgage broker in your team so that you can get the best up-to-date insurance price points on insurance policies for each property. Because again, every property is going to have a different insurance premium due to age, location, and a bunch of other factors. In this case, we'll just leave it at $212 for the sake of the example. Maintenance, I usually like to account for, and this is going to depend, right, and come with experience over time, but usually as a baseline rule of thumb, I like to account for around $50 per door per month, okay? And that's not taking into account larger actual aesthetic and structural renovations that you might want to bring to the property for forced equity. This is just a baseline monthly amount, okay? So in this case, it was a 6-plex, so we'll put times 6. Management, this can definitely vary depending on even whether or not you're gonna have management. I usually recommend that when you're new to property investing, you don't actually start off with management. You start to do it yourself so that you can learn the ins and outs of the trade. If you do end up going with management though, it's probably gonna be around 6% of the brute rents. So in this case, 6% of 4,000, it would be $242 per month. Now, vacancy, here's another expense that often we try to not account for, but you absolutely have to in your calculations. All right, so vacancy is essentially when someone is not occupying your unit and therefore you're eating the monthly running costs for that property or for that unit within the property. Okay, in this case, usually I put a 5% buffer, even though it's not really something I've ever not accounted for, but something I've experienced because my units are always rented, huge demand in this area. But vacancy, I'll put 5% of the monthly rent. So again, 5% of 4,000, we're looking at just above $200 in this example. And then a random, well, in this case, we have, $100. And that would really just be for other things like, let's say, grass cutting, snow removal, things of that nature. All right, $100 per month is usually around standard, especially on a property that has 6 units. So in this case, though, we would actually be looking at negative $405 per month because we take $4,000, subtract from that all of the expenses, we're looking at negative cash flow. So right off the bat, right at the gate, this isn't something that would really interest me unless there was actually more information that would lead me to be interested in the property, like zoning issues where I'm able to add units. That's usually something that would interest me. And other things like when the property is severely mismanaged, the rents are extremely low and the property is kind of like a dive. Well, then I know that I'm able to go in, probably negotiate with the tenants and end up renovating those units accordingly to bring them up to market value. And that's another way that you can create income. But just from a pure monthly cash flow standpoint, well, this property would be negative $405. So at this point, once section 2 is completed, we can transition over to section number 3, where most of it is already populated. So the first section is yearly cash flow. Now, in this case, with this property, we're looking at negative $405 per month in cash flow. So projected over a year times 12, we're looking at nearly $5,000 in the hole if you were just to purchase this as is with 20% down. And then the cash on cash return is essentially going to divide the monthly cash flows, or the yearly cash flows, I should say, in the first year by your total out of pocket. So the total out of pocket was $167,597. So cash on cash return, we're looking at the just under $5,000 divided by the total out of pocket, we're looking at a return of negative 2.9%. Obviously, that's completely unacceptable and isn't something that would ever make sense, at least in my books, in order to hold, especially in my market where in certain markets like Toronto, Vancouver, people purchase properties in order to, even though they're cash flowing negatively on a monthly basis because they're banking on appreciation. I never like to invest in like that because I like to guarantee a certain amount of return, and then appreciation over time is going to be gravy on top. In this case, though, some people or some investors do invest in an area to bank on appreciation, but especially when you're a first investor, having $5,000 in the hole per month, per year is something that's extremely detrimental. All right, now the second section though is equity year one return. So the total equity year one, essentially when you're paying down a mortgage and you're making those mortgage payments every single month, if you have a house, this is something you're familiar with, we have the forced savings mechanism. So you're building up equity in your property every single month. So this we can actually get from mortgagecalculator.org. So going back to that, when we looked at the amortization schedule, we can see that in 2022, for example, the interest that you're paying on that loan is this much and the principal is, $18,550. So I'm just going to take that value, bring it over right here, and we can see that that would actually give us an 11% return on equity in our first year. This is based on, again, our out of pocket of just under $170,000. So we're looking at 11% return, but that is, keep in mind, this is not liquid, right? This is just tied up in the property's value in question. And so the total return is going to take both of these and combine them together. So when taking all of this together, we're looking at returns of 8.17%. But again, you're burning $5,000 in your pocket every single year, and that's something as new investors is extremely difficult to cope with, and I would absolutely avoid this at all costs. All right, so that right there is how you can get a preliminary view of the numbers on a rental property when you're sifting through probably the dozens. If you're a first-time buyer, you're probably scouring the market every single day. This is how I take a look at the numbers initially before moving forward with speaking with my realtor, seeing if we can actually have an on-person visit. And really from there, an on-person visit is going to allow you to get obviously a better picture of the property in question. If you would be able to bring any additional value to the property, that could also, of course, offer more opportunity for creating a higher return on investment for yourself. But again, just the preliminary numbers, this is how I usually assess that from the get-go. And you can actually find this sheet down below in the description. Again, let's now look at a deal that I actually did in the past couple of years and see what type of returns we're looking at on that deal. All right, so this deal right here is actually a fourplex that I purchased in Gatineau 2 years ago at this point, and I actually sold it 2 months ago, and for a really great return on investment. That was definitely one of the biggest home runs that I've made to date in my real estate career, but this was a property that at the time was very mismanaged, and so on top of cash flowing from the get-go, it also offered a lot of opportunity to raise the rent because some tenants were leaving literally when I took possession of the place, and that obviously has a direct impact on the value of the place. So I'm going to overlay a photo of it as well as the fact that I had made a video when I actually closed on that property. So I had purchased it for $340,000, put 20% down on that property. So 20% down represented $68,000, and that is a substantial amount of money for sure, especially at the time. That was a lot. The way I ended up paying for that though is that I had sold a duplex, one of the first duplex that I purchased at the time, and just simply rolled that money right into this deal. So that's how I was able to do it, right? If you're a first-time buyer, make sure to understand that real estate is a long-term game and creates really a domino effect. Once you start building some equity, you can start pulling out that equity from deals, refinancing, maybe selling, and restructuring your deals in order to fund more and more deals at a more rapid pace. All right, so that gave us a sub-mortgage of $272,000 on that property. Renovation loan, didn't get one on that property. Mortgage insurance, no, because again, we put 20% down. So the down payment was $68,000 on that deal. Inspection was, again, around $500. Notary fees at the time was less, but let's just say like $1,550. The land transfer tax on that was not nearly as much as $6,000. It was around $2,750 if I remember correctly. Mortgage insurance tax, there is none. And then there was probably some, little other minor adjustments here or there, but I don't honestly remember. So I'll just put $100. Now, at the time though, the rents were extremely low when I ended up purchasing the property, right? So initially they were $720 for the first unit, $660 the second unit, $800 for the third unit, and the fourth unit was rented for $650. Now, what was great about that was that right out the gate, this one right here, the 800 unit, as well as the 650, those tenants happened to have been leaving right when we took possession of the place. So that offered an opportunity to right away renovate it, paint everything, change some floors, restructure a bit of the layout because we turned it into a 3-bedroom. But this allowed us to instantly raise the rents on both of these units that we're going to be revisiting. First things first, though, let's take a look at the mortgage. All right, so going back to the mortgage calculator. Again, $340,000. The rate on that, I'm pretty sure at the time was like 1.6%. Might have been a bit off from that, but it was right around there. So the monthly payment on that, just above, let's say, $1,100. We'll put that in right there. The taxes on that property were right around $270 a month total, if I remember correctly. Insurance on that property, yeah, around $200. The maintenance on it, other than the fact, we'll leave it at $200 just because that's my baseline. Management at the time, I did not have management, so we'll put it at 0. Vacancy, we can account for 5%, and then random. So right out the gate, I was looking at brute monthly cash flow of $805, which was absolutely fantastic, of course, and made this a fantastic investment. This property, this unit right here, though, instantly raised it up to $1,500 after putting in probably around not even, like a couple $1,000 to renovate the whole place and re-rent it. We're looking at $1,150, and then this unit rented it for $750 after painting it and bringing it really just back up to par. So right out the gate, $1,200. Now I know that sounds completely unrealistic right now, and even in the current market, it is. Like, I'm unable to find deals like this. This was a different market even 2 years ago, but the point just being, I'm constantly scouring the market and I'm constantly reinventing how I'm approaching these deals in order to make a return on my investment for property deals. And over time, even if you have a much lower return than this, over time, taking advantage of leveraging your capital, taking advantage of, even if it's $100 or $200 a month of cash flow and that debt pay down, creates really massive returns in real estate. All right, so this gave a cash on cash return year one of 20%. The equity in the first year was quite a bit less, $8,900. So we'll put that in right there. Whoops. We'll put that, $8,920. Right there. So the equity return was 12.2% for a total return in the first year of 32%. Right out the gate. All right, obviously this is absolutely fantastic. It was a home run, and actually recently I just sold it for $515,000, meaning on it capital gains of roughly, we had purchased it for $175,000 gained in about a year and a half, and that's also not taking into account the debt pay down over that time. So really fantastic deal and home run. Again, though, I do want to stress the fact that running the numbers is great on a property. Again, it can give you a good preliminary idea of what to expect, but it is absolutely critical that you walk the property, you see how it's been managed, how like the conditions of the place, because ultimately you're purchasing a piece of property and you're purchasing the problems that come with it. So it's always really important, once you've run the numbers, you're happy with something, to go on premise and actually see it before placing a bid, an offer, and trying to acquire the property in question. So I really hope you enjoyed today's video. If you did, make sure to drop a comment down below. If you have any questions, I will make sure to answer everything. Once again, you can find this spreadsheet and a couple other real estate freebies that I made down below in the description completely for free. Also, if you want to learn more about real estate investing and personal finance, I'd highly recommend that you subscribe, hit the bell button. I post videos on a weekly basis here, and also check out my full real estate investing playlist, right? I've made a bunch of videos there going over my strategy, different deals I've done, the steps to take to buy a first property. All of that is there for you. So thanks a lot for watching, and I will see you in the next one.